Digital Assets for Investors. Chapter 8, DeFi Fundamentals. Section 1, Decentralized Exchanges. A decentralized exchange, or DEX, lets you trade directly from your own wallet instead of first handing assets to a company. The trade is executed by smart contracts on a blockchain, so the platform is really software coordinating an on-chain swap. That means you remain in control of your funds until you approve a specific transaction. In practice, the other side of your trade usually comes from liquidity already sitting in a pool, rather than from a centralized exchange matching engine. This is why self-custody is such a central idea in DeFi trading. The convenience is powerful, but it also means the user takes more responsibility for wallet security, transaction review, and understanding how the protocol works. The biggest difference between a centralized exchange and a DEX is custody. On a centralized exchange, you typically deposit funds first, and the platform keeps control of those assets while matching trades internally. On a DEX, you keep your assets in your own wallet and interact directly with blockchain-based liquidity when you trade. Centralized venues often use order books, where buyers and sellers post bids and offers, while many DEXs use automated pools instead. That self-custody model reduces dependence on an operator, but it also removes some handholding. If you send a transaction on the wrong network or approve the wrong contract, there usually is no support desk that can reverse it for you. Most major DEXs do not rely on a traditional order book at all. Instead, they use automated market makers, or AMMs, which price trades with a formula based on the assets sitting in a pool. A common version is the constant product rule, written as X times Y equals K. You can think of X and Y as the pool's token reserves, and K as a value the pool tries to preserve as trades happen. When someone adds one token to the pool and removes the other, the balance changes and the implied price changes with it. So rather than waiting for another trader to meet your order, you are effectively trading against a mathematical system backed by pooled liquidity. Liquidity pools are what make continuous trading possible on many DEXs. A pool is a smart contract holding reserves of 2 tokens, and traders swap against those reserves instead of waiting for another person to appear on the other side. The people who deposit assets into these pools are called liquidity providers, or LPs. In exchange for supplying inventory to the market, LPs usually earn a share of the trading fees generated by swaps. This structure is what lets a DEX remain available around the clock, as long as there is enough liquidity in the pool. It also creates a trade-off. Traders get convenient access to swaps, while LPs take on risks in return for fee income. A token swap on a DEX usually follows a predictable sequence, even though the final result depends on live blockchain conditions. First, you choose the token you want to sell and the token you want to receive, then enter the amount and review the estimated quote. If the token has not been used with that protocol before, you may need a separate approval transaction that allows the smart contract to spend it. After that, you sign the swap transaction in your wallet and wait for network confirmation. During that waiting period, pool conditions can change, which is why the final amount received may differ slightly from the estimate. Once confirmed on-chain, the output token is delivered directly back to your wallet. Price impact and slippage are related, but they are not interchangeable. Price impact refers specifically to how much your own trade moves the pool price, which tends to be larger when your trade is big relative to available liquidity. Slippage is the difference between the price you expected and the price you actually got when the transaction settled. That difference can include your own price impact, but it can also come from delays, low liquidity, or market movement while the trade is pending. For example, a large trade in a small pool may already have meaningful price impact before you sign. If the pool shifts further before confirmation, your realized slippage can be even worse than the original quote implied. A small numerical example makes this easier to see. Suppose a pool holds 1, OO, ETH, and 3, 5 million USDC, which implies a price of about 3,500 USDC per EH. If you swap 500 USDC per EH, if you swap 500 USDC and the fee is 0, 3%, only 498. 5 USDC actually goes into the pricing formula. In a pool this deep, that produces roughly 0, 143 ETH, very close to what you would expect from the headline price. The reason is that your trade is tiny compared with the total reserves, so it barely moves the pool. This is why deeper pools generally provide better execution for ordinary trade sizes. Using a DEX gives you flexibility and self-custody, but it does not remove risk. One category is protocol risk. If the smart contract has a bug or exploit, funds interacting with it can be affected. Another is liquidity provider risk, especially impermanent loss, which can reduce returns versus simply holding assets. Execution risk also matters because pending trades can be seen in the mempool and potentially targeted by front-running or other forms of MEV. On top of that, network gas fees can make small trades surprisingly expensive. So even a simple token swap sits at the intersection of code risk, market risk, and transaction cost risk. Many expensive DEX mistakes are avoidable because they come from settings, assumptions, or simple inattention. One common error is choosing a slippage tolerance without really understanding what it allows the trade to do. Another is ignoring gas fees, especially when the trade size is small enough that fees consume a large share of the value. Traders also sometimes connect to the wrong network or confuse similar-looking tokens across chains. In shallow pools, people may focus on the quoted price and overlook how much the trade itself will move the market. And because some tokens require a separate approval first, forgetting that extra step can create confusion or, if handled carelessly, unnecessary permission risk. A practical way to compare DEX quality is to quote two trade sizes in the same pool and study the difference. For example, you might check a small DAI 2-wet swap and then a much larger one without actually executing either trade. Record the estimated output, the stated price impact, any slippage settings, and the gas cost involved. Then compare the amount of wet received per one DAI in both cases. You will usually find that the larger trade gets a worse effective rate because it moves the pool more. That simple exercise helps turn abstract ideas like execution quality and price impact into something visible and measurable. Section 2. Lending Protocols. DeFi lending protocols let users lend and borrow crypto through smart contracts rather than through a bank or broker. Instead of matching one lender directly with one borrower, most major systems use a shared pool of deposits. Lenders add assets to that pool and earn yield, while borrowers draw assets from it after posting collateral. The protocol's code manages interest rates, tracks collateral levels, and enforces the rules automatically. If a borrower becomes too risky, liquidation can also happen through the protocol rather than through a manual credit process. So the system replaces traditional underwriting with pooled liquidity, collateral requirements, and automated risk management. Over-collateralization is common in DeFi because most protocols do not rely on identity checks, income verification, or credit scores. Instead, the lender is protected by requiring the borrower to post more value than they are borrowing. If someone wants to borrow $100 worth of stablecoins, they may need to lock up $150 or more in crypto collateral. That extra cushion helps absorb normal market volatility. But if the collateral falls enough in value, the loan can still become unsafe and move toward liquidation. Uncollateralized lending does exist in some corners of crypto, but it is much less common because it usually depends on trust, legal agreements, or institutional relationships rather than purely on smart contract rules. Interest rates in DeFi lending are usually formula-based, not negotiated person to person. A key concept is utilization, which is the amount borrowed divided by the amount available in the pool. When utilization is low, there is plenty of idle liquidity, so borrow rates are usually lower. As utilization rises and available liquidity gets tighter, the protocol increases borrow rates automatically. Those higher rates can discourage some borrowing while attracting more deposits from lenders looking for yield. In effect, the rate model tries to balance supply and demand without a loan officer deciding case by case. When lenders deposit assets into a lending protocol, they usually receive a tokenized claim representing that position. These are often called receipt tokens, and examples include seconds or A tokens, depending on the protocol. The token shows that you have deposited assets, and it also reflects the interest that accrues over time. Instead of your balance growing in a bank-style account statement, the value or redeemability of that receipt token changes according to the protocol's rules. In some cases, those tokens can also be used elsewhere in DeFi, such as for collateral or other strategies. that can improve capital efficiency, but it also layers one protocol's risk on top of another. For borrowers, the key metric to monitor is usually loan-to-value, or LTV. LTV is the value of the loan divided by the value of the collateral, so it rises when collateral falls or when the debt grows through interest accrual. A position that looks safe at the start can drift closer to liquidation even if the borrower takes no new action. For instance, a borrower with $10,000 of collateral and $5,000 of debt starts at 50% LTV. If the collateral drops to $8,000 or the debt rises over time, that ratio moves higher. Once it crosses the protocol's threshold, liquidation becomes possible, which is why prudent borrowers leave a meaningful buffer instead of borrowing to the maximum. Lending protocols need reliable price data because the whole system depends on knowing what collateral is worth. Oracles provide that external price information to the smart contracts. Those prices help determine how much a user is allowed to borrow and whether a position is still healthy. If the oracle says collateral is worth less, borrowing capacity falls and liquidation risk rises. If the oracle data is wrong or stale, the protocol can make bad decisions, including liquidating safe positions or leaving risky ones open too long. That is why oracle design is not a side detail in DeFi lending. It is part of the core risk engine. A typical lending transaction follows a fairly repeatable life cycle. First, a lender deposits assets into the protocol and receives receipt tokens representing that claim on the pool. A borrower then supplies collateral and, based on that collateral's value, draws a loan within the allowed limits. From there, the protocol continuously monitors the position's LTV as market prices and interest charges change. If the position becomes too risky, liquidators can step in and repay part of the debt in exchange for collateral, usually at a discount or bonus. If the borrower repays the loan plus accrued interest before that happens, the remaining collateral is unlocked and returned. Borrowing close to the maximum allowed LTV can look efficient, but it leaves very little room for error. Imagine a borrower posts 20 EH when ETH is worth $2,000, so the collateral is worth 40,000. If the protocol allows up to 80% LTV, the maximum borrowing limit is 32,000. Borrowing 30 trials 80 RAL Senate may feel conservative because it is below the maximum, but the actual safety buffer is thin. A moderate drop in ETH price can push the LTV sharply higher, especially once interest on the debt is included. This is why experienced borrowers rarely treat the protocol maximum as their personal target. DeFi lending is efficient, but it comes with real constraints for both lenders and borrowers. Borrowers face liquidation penalties if collateral falls too far, and variable rates can rise quickly when utilization increases. Lenders, meanwhile, may discover that withdrawals are slower or less available when much of the pool is already borrowed. On top of that, smart contract failures can threaten deposited funds, and oracle problems can distort the protocol's view of risk. Even gas costs matter, because reacting to a risky position can be expensive during network congestion. So the system may be permissionless, but it is far from frictionless. The practical takeaway is that DeFi lending replaces traditional credit analysis with collateral rules, pooled liquidity, and automated enforcement. For lenders, the appeal is earning yield from borrower interest without having to select individual borrowers. For borrowers, the appeal is fast access to liquidity without selling an asset they want to keep. But the usefulness of the system depends heavily on position sizing and discipline. Staying well below the maximum LTV creates room for volatility, delays, and interest accrual. In DeFi lending, risk management is not a secondary consideration after returns. It is what makes the returns usable in the first place. Section 3. Yield farming. Yield farming means putting crypto assets to work across DeFi protocols in search of return. A common version starts with supplying liquidity to a pool, receiving LP tokens that represent your share, and then staking those LP tokens in a separate rewards contract. That means the return can come from more than one place at once. You may earn trading fees from the pool itself, and additional token incentives from the protocol trying to attract liquidity. In that sense, yield farming is usually more layered than simply holding an asset or depositing it into a lending market. The opportunity can look attractive, but the number of moving parts increases quickly. Yield farming differs from holding and lending mainly in how active and complex it tends to be. With buy and hold, your outcome depends mostly on whether the asset price rises or falls over time. With lending, the return is usually a more straightforward interest rate tied to borrower demand. Yield farming combines multiple sources of return, such as trading fees and incentive tokens, but those sources can change quickly. Farmers often move capital between pools or protocols when reward schedules shift or token prices change. So farming is less like passively owning an asset and more like actively managing a strategy. A typical farm usually involves two linked steps rather than one. First, you choose a token pair and deposit equal values of both assets into a liquidity pool. In return, you receive LP tokens that represent your share of that pool and your claim on trading fees. Then, in many setups, you stake those LP tokens in a separate farm contract to earn extra incentive tokens. Over time, you decide whether to claim those rewards, reinvest them, or exit the position. Exiting often means unstaking the LP tokens first and then redeeming them for the underlying assets. Each added step can improve return, but each step also adds cost, complexity, and risk. Most farming returns come from two main sources. The first is trading fees paid by users who swap through the pool, and that income tends to depend on how much trading volume the pool actually sees. The second is protocol incentives, usually paid in the project's own token or another reward token. Those incentives can make a farm look much more attractive on paper, especially in its early stages. But unlike fee income, token rewards depend not only on how many tokens you receive, but also on what those tokens are worth when you sell or hold them. So, a quoted yield can be partly driven by real market activity and partly by emissions that may prove temporary. Protocols offer token rewards because they want liquidity and users quickly. Deep liquidity helps swaps execute more smoothly, improves market function, and makes a new DeFi product more usable. For a newer protocol, incentives are often the fastest way to attract deposits before organic demand has fully developed. Governance tokens can also help create a user base that feels invested in the protocol's growth. But there is an important distinction between durable liquidity and incentive-chasing liquidity. If deposits arrive mainly for the rewards, and not because the market is genuinely useful, that capital can leave just as fast when emissions decline. Yield farming is often described with passive-sounding terms, but in practice it is not very passive. APRs and APIs can change fast as more capital enters a farm, or as reward schedules are updated. The value of the reward token itself can also fall, reducing your realized return even if the token count stays the same. Gas fees matter too, because claiming and reinvesting may cost enough to change the economics of the strategy. On top of that, price divergence between the pool assets can affect your final outcome through impermanent loss, so farming typically requires monitoring, decision-making, and a willingness to adapt rather than simply setting and forgetting. Headline yield can differ a lot from real return once prices start moving. Imagine you deposit $10,000 into a farm that totals $1 million, so you own 1% of it. If that share earns $10 a day in fees and 5 reward tokens worth $2 each, the initial estimate is about $20 a day before costs. That looks appealing at first glance. But if the reward token falls from $2 to 50 cents, those same 5 tokens are suddenly worth only $2.50. Without any change in your position size, your expected daily return drops sharply, which shows why reward token price risk matters so much. Impermanent loss is one of the most important concepts in yield farming because it can quietly offset the rewards you are earning. It happens when the two assets in a pool move apart in price, causing the pool to rebalance your position automatically. As a result, your final value can end up lower than if you had simply held the original assets outside the pool. The larger the price divergence, the penum-troll underperformance tends to be. It becomes real when you withdraw, because that is when your share is converted back into specific token amounts. Fees and incentives may offset that shortfall, but they may also fail to do so. Gas costs can have a major effect on farming results because the strategy often involves many separate transactions. You may need to approve tokens, deposit into a pool, stake LP tokens, claim rewards, reinvest, and eventually unwind the whole position. Each of those actions can carry a network fee. For a small position, those fees can consume most or even all of the expected yield. For a larger position, the same dollar cost may be much easier to absorb. That is why the right question is not just what the farm advertises, but what remains after total transaction costs are taken into account. Compared with lending and staking, yield farming usually offers more upside on paper, but also more ways for results to disappoint. Lending is typically simpler and often provides steadier yield from borrower demand. Staking usually involves one asset and a more direct return tied to network participation or protocol design. Farming, by contrast, combines pool mechanics, reward token price risk, gas costs, and impermanent loss. So even if the quoted return is higher, the path to realizing that return is more complicated. A higher advertised yield does not automatically mean a better investment outcome. Section 4. Liquidity pools. A liquidity pool is a smart contract that holds reserves of tokens so trades can happen directly against those reserves. Instead of matching one buyer with one seller through an order book, the pool stands ready to facilitate swaps as long as assets remain in it. This is one of the core building blocks behind decentralized exchanges. A trader can send in one token and receive another without waiting for a specific counterparty to appear. The pool is therefore less like a list of open orders and more like shared inventory available to the market. As long as liquidity is deep enough, that inventory supports always-on trading. Many automated market makers set prices using a mathematical rule, and the classic example is the constant product formula, x times y equals k. Here, x and y represent the reserves of two tokens in the pool. When a trader adds more of one token and removes some of the other, the reserve ratio changes. Because the ratio changes, the implied price changes too. This is the key idea behind AMS. Price is not chosen manually or posted by a market maker, but emerges from the state of the reserves. It is a simple model, but it has powerful consequences for execution price and slippage. Liquidity providers, or LPs, are the users who supply the assets that a pool needs in order to function. In a typical pool, they deposit equal values of both tokens at the current market ratio. In return, they receive LP tokens or another position record showing their proportional ownership of the pool. That share entitles them to a portion of the fees generated when traders use the pool. Over time, as swap fees accumulate in the reserves, the LP's claim can become more valuable. But the exact mix of assets they own to the pool can change as trading and arbitrage continuously rebalance the reserves. A liquidity pool usually follows a simple life cycle from creation to withdrawal. First, a token pair is established and initial reserves are added. More LPs can then contribute assets at the current ratio, increasing the pool's size and depth. Traders begin swapping against those reserves, which changes the balances and generates fees for the LPs. Over time, the pool's composition may drift significantly from the original deposit mix. When an LP exits, they redeem their share of the current reserves, not necessarily the same token amounts they originally put in. Consider a simple ETH and USDC pool holding 10 ETH and 20 W0000 DC. At that starting point, the implied price is 2 W0000 DC per ETH, and the constant product is 200 W00. If a trader buys one ETH from the pool, the ETH reserve drops from 10 to 9. To keep the product roughly constant, the USDC reserve must rise to about 22. That means the trader has to add around 22 USDC to remove that one ETH, ignoring fees for simplicity. The example shows why taking assets out of a small pool can move the internal price sharply. This example also helps separate three prices that are often blurred together. The starting spot price is the pool's quoted marginal price before the trade, which here is 2,000 ZC per ETH. The execution price is the average price the trader actually pays across the whole swap, which in this case is about 2,222. 22 USDC for one ETH. After the swap is complete, the pool's new marginal price is even higher, around 2,469. 14 USDC per ETH. So the trader starts at one price, pays an average price in between, and leaves the pool at a final price that reflects the updated reserves. That difference is the practical effect of price impact and slippage in an AMM. Pool prices do not stay disconnected from the rest of the market for long because arbitrage traders watch for gaps. If a big trade pushes the pool price away from the broader market price, arbitrageurs can profit by trading against that difference. Their trades move the reserve ratio back toward alignment with external prices. In doing so, they help the pool remain useful as a market venue. But their activity also changes the asset mix held by liquidity providers, because the pool is being rebalanced through those corrective trades. So arbitrage is not just a side effect of AMMs. It is one of the mechanisms that keeps them anchored to reality. Impermanent loss becomes easier to understand when you compare providing liquidity with simply holding the same assets. Suppose you deposit 1 EH and 2 W000 USDC when EH is worth 2 W00. If ETH later rises to 2,500, simply holding those assets would leave you with 4,500 USDC of value. In the pool, however, arbitrage causes your position to rebalance into less EH and more USDC as ETH rises. In the example, that rebalanced pool position ends up worth about 4,472, 14 USDC instead. The difference is about 27. 86 USDC, or roughly 0 to 60%, and it represents underperformance versus holding. It is called impermanent because the gap can shrink if prices return, but if you withdraw while the gap exists, the loss is effectively realized. Fee income is the main reason people provide liquidity, but it has to be judged against several kinds of risk. Swap fees can accumulate nicely in active pools with strong trading volume. In some cases, those fees are enough to offset impermanent loss and leave LPs ahead. In other cases, large price divergence between the assets can overwhelm the fee income. On top of market risk, there is protocol risk, because a smart contract failure or exploit can damage the position regardless of trading activity. The real question for an LP is not just how much the pool pays, but whether fees are likely to exceed the risks being taken. Constant product pools are the standard foundation, but they are not the only design. For general trading pairs, they work well as a flexible starting model. Though large trades can create noticeable slippage, other pool models are designed for assets that tend to stay near the same price, such as closely related stable assets, and these can offer better capital efficiency around that range. Concentrated liquidity models go further by letting LPs place liquidity within chosen price bands rather than across the entire curve. That can improve execution when the market stays inside the active range. But it also increases management demands and can leave LPs less effective or more exposed when price moves outside their chosen range. Before providing liquidity, it helps to evaluate both the mechanics of the pool and the risks around it. Start by remembering that LPing is not a risk-free yield activity. It is a market-making role with real exposure. Make sure you understand the difference between spot price, execution price, and the way trades create price impact. Then look at practical indicators such as fee tier, trading volume, and depth, because those affect both revenue and execution quality. Also keep in mind that your withdrawal reflects the pool's current reserves, not your original deposit mix. A careful review of those points can prevent the common mistake of treating LP returns like simple interest. Section 5. Smart contract risks. Smart contract risk matters because DeFi is built on software that directly controls assets. These contracts handle trading, lending, staking, and other core functions without a human intermediary approving each step. That automation is efficient, but it also means the contract will execute exactly as written, whether the code is good or bad. If there is a flaw, harmful transactions can still be processed with the same reliability as legitimate ones. The stakes rise further when large pools of user funds sit inside the system. In DeFi, a software mistake is not just an IT problem. It can become an immediate financial loss. Smart contract risk is broader than just simple coding mistakes. It includes direct code vulnerabilities, but also design flaws in how the protocol is supposed to work. A system can be written exactly as intended and still be unsafe if the underlying economic logic is weak. Risk also comes from connected systems, such as oracles, bridges, admin controls, or upgrade mechanisms that the main protocol depends on. Attackers look for the weakest point in that wider structure, not just a typo in one function. The result can be funds drained, funds frozen, or a protocol left economically insolvent. Several exploit patterns appear again and again in DeFi. Reentrancy attacks abuse the order of operations inside a contract so that funds can be withdrawn repeatedly before balances are updated. Flash loan attacks use large amounts of temporary capital within a single transaction to manipulate markets or exploit weaknesses. Oracle manipulation targets the price feeds that protocols rely on for collateral and liquidation decisions. Logic errors come from flaws in the protocol's own rules, while governance attacks exploit control over voting power to change the system for private gain. Although these attacks differ technically, they share the same basic outcome. The protocol behaves in a way its designers did not intend. An exploit often unfolds quickly once a weakness is found. The code is public on-chain, which is useful for transparency, but also means attackers can inspect it closely. Regular users continue interacting with the protocol through normal transactions, often unaware of any hidden issue. If an attacker identifies a vulnerability, they can craft transactions specifically designed to trigger it and extract value. In many cases, the damage happens in minutes or even seconds, especially when bots are involved. Afterward, teams may pause the protocol, patch the code, or migrate users to a new contract, but the financial loss may already have occurred. A reentrancy attack is a classic example of how a small programming mistake can create outsized damage. Imagine a lending pool with $10 million in deposits that processes withdrawals by sending funds before updating the user's recorded balance. An attacker can exploit that sequence by triggering a withdrawal and then re-entering the function again before the balance update happens. If this loop is repeated multiple times in the same transaction, the contract may keep paying out as if the funds were still available. In the example here, re-entering 10 times allows $500,000 to be extracted. That would translate into a 5% hit to depositors, all because the contract handled the steps in the wrong order. Audits are helpful because they can uncover known weaknesses and improve a protocol's security posture before launch. But an audit is not proof that the code is perfect or that every future interaction will be safe. DeFi systems often connect to oracles, governance modules, bridges, and upgrade paths, and those complex relationships can create edge cases and audit misses. Even audited contracts have failed in the real world. Newer protocols are especially risky because they have less time in production and fewer battle-tested assumptions. So an audit should be treated as a positive signal, not as a guarantee. When assessing a protocol, it helps to look for multiple layers of defense rather than one reassuring label. Audits before launch are one layer because they bring external review to the code. Formal verification can add more confidence by checking whether important logic behaves as intended under defined assumptions. Time-locked upgrades matter because they give users notice before changes become active. Multi-sig admin controls reduce single-key risk by requiring several approvals for sensitive actions. Insurance or safety funds may also help offset some losses, though coverage terms and limits vary widely. Many investor mistakes come from confusing risk reduction with risk removal. One of the most common is assuming that an audited protocol is therefore safe. Another is ignoring admin powers and upgradability, even though those controls can materially change the rules after you deposit. Investors also chase high yield on unproven code without asking why the return is so high in the first place. Some fail to monitor the protocol over time, even though governance votes, upgrades, and dependency issues can alter the risk profile later. And in composable DeFi, exposure often extends beyond one app, because a failure in a connected protocol can cascade into the one you chose. A practical protocol review combines security signals with sensible position sizing. Start by treating audits as helpful evidence, but not as the final answer. Look carefully at any disclosed warnings, unresolved issues, or recent incidents, because those often matter more than marketing language. Check whether the protocol is upgradable, whether upgrades are time-locked, and whether admin powers are protected by a credible multi-sig. If insurance, reserves, or treasury backstops exist, understand what they actually cover and what they do not. Even after all of that, the final discipline is simple. Do not deposit more than you can afford to lose. The practical takeaway from smart contract risk is that code has become part of the investment thesis. In DeFi, higher yield often comes bundled with higher technical uncertainty. Protections such as audits, bug bounties, multi-sigs, and insurance can reduce risk, but they do not erase it. Small flaws can still lead to large losses when automated contracts control large pools of capital. That is why position sizing matters so much. A sensible investor evaluates both the return and the security posture, then sizes the position with worst-case outcomes clearly in mind.